Hello and welcome back. My name is Kirkpatrick. I'm the owner and founder of Life 180 and the creator of the Life 180 Roadmap. We are winding down week one right now, and this is going to be the final video for week one. And so far, we've talked about a lot of key things. I know it may not feel like rubber's kind of hit the road yet, but I promise the stuff we've talked about to this point is absolutely essential. And we've talked about the history of money. We've talked about the current paradigms that people are living in with their money and how the next 25 years is not going to look like the last 25 years and why that's different. We've talked about the importance of creating your own microeconomy, and that may not happen right away depending on what your financial situation is, but it will get there, right? And that's what we're working towards, because that's where ultimate financial freedom comes, because then you put yourself in a position that no matter what's going on in the economy, no matter what's happening around you, you're going to be insulated from all that. And if nothing else, you're actually going to look forward to the swings in the market, because you're going to be able to thrive and prosper and take advantage of those situations. So that's fantastic. That's the optimum position to become, to put yourself in. And so then finally, we talked about compounding interest and how it's the eighth wonder of the world. Albert Einstein said, compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And so that's where we're lost in the world right now. And you know, if you look back through history, as we talked about, historically speaking, people think about history in very short-term periods. And the reality is what people think to be true today isn't necessarily true. And what people think is normal today may be normal for right now, but it's not normal historically speaking. The debt that we're in, you know, credit cards weren't even a normal thing until the early 80s. You know, the 401ks weren't even created until the early 80s. Roth IRAs, 1998, and so on and so forth. The list goes on and on and on. A lot of the things that people are using today as strategies and tools and products to create their retirement strategies and savings vehicles and all that stuff, they're all stuff that are relatively new in comparison to old strategies that have been proven to work for hundreds of years. And so when you take that into consideration and you look at the results that America's getting right now, and 92% of Americans are not able to maintain their standard of living when they retire today, after the fact they've been doing this for the last 30 years, I'm just going to look at those results and say that, you know what, there's a glitch in the matrix. Something's wrong. So what I want to do now is I want to talk about something I call my Life 180 pyramid. Now you can see a couple triangles over my shoulder here. And what those are is, after doing about 5 years of study and 5 years of research of being in the industry, I realized there were some problems, right? I mean, I was one of the top recruiter, developer, trainers for a Fortune 1000 company, financial company in the entire country. And as I went through the process and I developed a team and I learned more and more and more, I'm just the kind of person who's not going to take things at the status quo. And the more I learned, the more I dug, the more I realized there were some serious problems. So what I wanted to do was I wanted to share a lot of the stuff that I learned, and I put it into a story, because it's pretty complex stuff, but I wanted to simplify it and put it in a story. And here's what I came up with. Now, a lot of times, money is complex, right? Personal finances, people get overwhelmed because it's a complex topic, right? And what happens is people overly complicate things because they just, they don't know what they don't know. And so what I want to do is break it down and make it very, very simple. And so we start with a financial pyramid. Now, if you go take the CFP exam or course and you want to become a certified financial planner, you have to learn about something to do with a financial pyramid. Now, I'm going to simplify it a little bit because I think it's important that we simplify these things and make them as simple as possible. But simply put, how do you build a pyramid? Like any other structure, you have to start from the bottom up. It makes no sense to build the roof first, right? If you build the roof of your house first before building the foundation, it may be pretty, but eventually it's going to crumble. And so the same thing goes with the pyramid. You don't build the top part of the pyramid first, you build the foundation. And you build the foundation of your financial life with safe money, with insurances, by making sure that you're protected. Now, I'll get into all of that in a later, in a later module, and we'll make sure that you understand that completely. But for the sake of this, know that you have to have your safe money, your rainy day account, safe access to capital, access to cash for opportunity. You need to make sure you have your insurances lined up, your disability insurance, your homeowner's insurance, your auto insurance, your life insurance, anything like that lined up, an umbrella policy if you need it. And then that's where you need access to money all short term. Any money that you think you may need short term needs to be there, because you can't take risk with it. Secondly, once you do that, then you can get into some medium term investment stuff that maybe is a little further out, 5 to 10 years. type period, taking a little more risk, but not a lot more risk. This isn't your high risk stuff. And then finally, the high risk investments are on the top. That's money that you're not going to be able to, or not need to touch, I should say, for 10 to 20 years. And so if anybody who has money in that account shouldn't need to touch it for 10 to 20 years. Now, here's the problem. That's what's taught when people become financial advisors, when people become financial planners. But the thing is, most financial advisors are simply glorified salespeople. That's all they are. And so here's what's going on. While 5% of people in this country actually have their life structured like that, the reality is that 95% of people have their life structured in what I call an inverted pyramid, an upside down pyramid, right? And what happens is when you have this upside down pyramid, you put yourself in a situation where your whole financial stability is based on one point of instability. Instead of having a big, solid base of structure and stability, everything is teetering on this one little point. And why? Well, let's talk about it a little bit, because the reality is the National Institute for Retirement Income did a study. And in that study, they said 64% of Americans had less than $2,000. 64% of Americans didn't even have access to $2,000 in case of an emergency or opportunity. Now, what does that mean? That means 36% of people said they did have access to $2,000. But here's the trick. Out of those 36%, 70% of them got it from their 401k. Now, here's the challenge. The 401k, not a bad account. It's just key to understand what that account does. I'm not saying it's bad. I'm not saying don't do it. I'm just saying understand what you're doing, understand where your money's going and how it's working for you as a tool and how you can leverage that tool. Now, what's going on with the 401k is, typically speaking, that money goes into high risk investments, because one of the things that's taught, one of the fallacies that's taught in this country around money is the younger you are, the more risk you can take. And honestly, the younger you are, the less risk you need to take. Why? Because you have time on your side. And if you understand the power of compounding interest, you understand that you never want to take money and take risk with it unnecessarily. And you should never invest in anything you don't understand, because that's taking unnecessary risk. So we'll get into that. And so here's the thing. If that's the case, 70% of people said, out of the 36% that said they did have it, got it from their 401k. What's that lead to? If you touch money in your 401k early, before you're 59 and a half, and you use that as an emergency account, you use that as your safety account, you have to pay taxes and you have to pay penalty on that money. And last year, I don't care so much about the taxes, because you're always going to have to pay earned income tax on that money. But what I do care about, what I absolutely do care about, is the penalty. And last year alone, Americans paid $7 billion in penalty just to access their own money. That's money the government's taking from Americans, middle-class Americans, to access their own money. And when you do add the taxes into it, there was another $14 billion in taxes paid. Literally $14 billion. So now we look at it, last year between the two, Americans paid $21 billion in taxes and penalty just to access their own money from their qualified accounts before they were 59 and a half, because they needed it. Now, that was 2014. That was during a good economic environment. What's going to happen when things go bad? Because we know that the market is cyclical, right? It goes up, it goes down, and so on and so forth. And here's how it goes. We know that the market takes longer to go up, and then it goes down fast, and then longer to go up, and it goes down fast, longer to go up, and it goes down fast. Now, what happens here, you notice it goes up, and this is a slow trend upward, right? Slow trend upward. But the bottom line is, these upslopes take a lot longer than the downslopes, right? The downslopes happen violently. They happen suddenly. They catch us by surprise, and a lot of people get caught. They get stuck with their money in the wrong places, and they lose their shirts, right? And so the thing is that if we know it takes 8 to 12 years for the economy to go up, and it can take 1 to 2 years to come down, and usually it happens really, really quickly. It actually can, I say 1 to 2, I'm being very generous there. Usually it's between 6 months and a year that it comes down, and it happens like that, like suddenly. And so if we know that's the case, well, when's the best time to make money? When everybody's making money, right? Or when everybody's struggling, right? When the market goes down. Well, the reality is that when times are tough, when the sky is falling, when Chicken Little syndrome, I call it, kicks in, that's the time that you want to be in a position to make money. And everybody talks, all the politicians talk, Main Street America talks, the media loves to talk about it, that there's this growing divide between the wealthy, right, between the 1% and between middle class. And is that happening? Absolutely it's happening. The statistics don't lie. But why is it happening? Well, the reason is because of the way that people are structuring their financial life. And what I want to do to you is show you a way to insulate yourself from being part of the middle class that's shrinking and put yourself in a position and using the principles that the top 5% of the people in this world, in this country, use and implement in their own lives to make sure that not only are they insulated from these downtimes, but they prosper, they thrive, they actually look forward to the opportunity. Why? Because when the best time to make money is when there's blood in the streets. And I don't remember who said that right now, but that phrase sticks in my head, and it sounds kind of gruesome, but it's the reality. When people are struggling, that's the way it goes. Now, here's why. Let's just go through this cycle. You can't spend paper profits, right? You cannot spend paper profits. So what happens is people start, let's say you got a 30-year-old who starts their savings career, and they go through this 8 to 12 year cycle. Well, things look good, right? Things feel good, the economy's humming, they're getting a good rate of return, and they're putting all their money into their 401k, into this high risk investment, because the younger they are, the more risk they can take, and all seems well, right? Their job is stable, they got a 401k, they got a match from their employer, all that stuff. But then what happens? 10 years in, boom, the market tanks. What happens? They lose half their account value. This is gone, right? What happens? They don't have any money saved in an account, right? So what happens then? Because they don't have that, they probably lose their job. So when they lose their job, what happened? The economy's struggling, unemployment rates go up, asset prices come down, and so what's going on is people in this structure lose opportunity because they don't have access to this. What do they need to do? They need to pull money out of their 401k to just pay their bills, to pay their mortgage, to make sure that they can feed their family, just to survive. And so before you know it, they've taken all their money out of a negatively performing asset, which is absolutely the worst thing you can do, is to take money out of a negatively performing asset. And so what happens? Because they had their whole life built on this one little point of instability, their whole financial pyramid falls over and it's crumbled, right? Completely gone. And when that happens, you got 8 to 12 years, boom, now what are they doing? The market starts here, but what are they doing? They're starting right where they started. They're starting down here, and they're going to try to play catch up, and then it's going to happen again. And if they don't do it differently, it's going to happen again and again and again and again, and it repeats that cycle. But I can tell you this, if you're working and if you go through a 40-year career, that only has to happen to you once or twice to make it virtually impossible for you to hit your retirement goals. And I'm telling you right now, you don't want to fall into that trap. And so what I want to do is I want to show you a way. The wealthy people in this world, the most successful people in this world, don't take unnecessary risks. They don't invest in things that they don't understand. They wait, they keep their money safe, they bide their time, and they wait for the right opportunity. Now, what do you think the opportunity is here? I mean, I could tell you right now, think about 2000 through 2008, the real estate market went up and it crashed, right? People who bought real estate in 2008 for pennies on the dollar, you know, I have a personal mentor of mine who bought 4 houses in Florida. They were selling for $350,000. They were selling for in 2006. At the end of 2007, he bought 4 houses for between $70,000 and $85,000 a piece. By 2011, he was able to sell all those houses for between $340,000 and $360,000. Now, that is an awesome investment. How much risk did he take? Well, not as much as he would have if he bought it for $350,000, right? Obviously, because he's got less skin in the game. But how did he get them? You don't just buy those houses with loans and with leverage and all that stuff. You have to do it with access to capital. You have to have your own cash. You have to be able to fund that yourself. So I'm going to teach you how to do that later in this course. But from a structure perspective, you have to understand that that is the most important thing. Now, a lot of his friends laugh at him because he kept his money safe and he wasn't earning the 8, 10, 12% on his money during that time. He was earning a measly 3, 4, 5%, right? And his friends are picking on him. But then when his friends lost all their money and he was able to just come in, cash in, and just make bank on that and make 400% profit in 3 years, where are you going to do that? You only can do that if you make sure you time the market appropriately. And I'm not saying try to time the ups, but I am saying when people make bad decisions when the market's going down, and they make bad decisions because they're in it. and they're emotionally invested because they're scared to lose their money. But if you're prepared for it and you set yourself up accordingly, you're not going to be scared at all. You're going to be looking for that opportunity. Rather than looking for the opportunity on the way up when 95% of the people are looking for that opportunity, you're going to be looking for the opportunity on the way down when 5% of the people in this world are looking for that opportunity. You're not going to find a person alive that's going to achieve 5% results by doing the same thing as 95% of the people in the world. And so that's what I want to show you in this course. So I'm going to erase this little part down here because I want to keep going with this and I need to reuse this area. But I hope that makes sense for you. And so here's the deal. What's this look like? We all understand that. So when the world kind of goes to hell and when the economy falls apart, right? That means opportunity goes down over here, right? Just kind of what I explained, and it goes up over here. Opportunity. So as opportunity goes down over here, it goes up over there. And so it allows, the best way to get rich is to buy low, sell high. So as these guys, as asset prices go down and they make bad, poor, desperate financial decisions just to survive, the people over here with access to capital, with safe money that they have liquidity, use, and control over, those are the people that take advantage of it. So what does it look like? How do you simplistically, how do you structure your life? What are things that you need to do? What are some principles? And that's what I want to convey to you right now. What are some principles that you can implement in your own life? And the whole purpose, the reason I have this at the end of week 1, the whole purpose is I want this roadmap program to be a tunnel, right? I want to show people a way that they can dig their way out of this hole that everybody in this country, for the most part, the vast majority of people are living in. I want to help you build a tunnel and get over here. Now, what's the first thing you need to do? You need to get out of debt. You need to build that foundation. So I'm going to actually build a sub foundation right here. And this is debt, right? We need to eliminate this debt. We need to get out of that. Once we get out of that, it's kind of like the excavation period, right? Before you pour a foundation for a house or a big building, you need to excavate. You need to go in, you need to dig that, you need to form the walls and all that stuff. That's the debt elimination. That's the rebuilding your credit portion. That's all that stuff. So you want to make sure you do that. But once you do that, once you build that, once you excavate and you get prepared, now you want to have your safe money. So what's that look like? I'm gonna draw this down here. So the safe money, here's what I'm gonna say. You need 2 years of income. That sounds like a big number, right? Don't be scared by it, because I'm gonna show you how to get there. I'm gonna show you how to do there on a 100% guaranteed, predictable basis. It's not gonna happen overnight. That's the one thing I can promise you. This is not gonna happen overnight, but it's gonna be worth it. My question to you is this, is so many people out there talk about making it so you have only 6 months in a savings account, 6 months in a rainy day account, just in case. Well, my question to you is this, is why 6 months, right? Before you make any decisions from now on when it comes to your money, the first thing I want you to ask yourself is why? Why are you doing it? Why make that decision versus another decision? And so my question to you is why 6 months? And when I thought about that, I didn't understand, right? Well, why the Dave Ramseys of the world, why the Susie Ormans of the world say 6 months. And the reason it doesn't make sense to me is because the average length of unemployment right now in the economy, the unemployment rate right now is at an all-time low for the last 15, 20 years. And that may be the case, but the labor participation rate is the worst it's been since the 70s, right? So what we need to be concerned about is what's going to happen if you lose your job, if you're unemployed. How long is it going to take for you to get another job? Well, the statistics show right now that the average length of time for you to get another qualifying job that you just lost is over 9 months. So why are we going to talk about 6 months of cash reserves if 9 months is that? What happens when this happens, right? It's not a matter of if, it's a matter of when. And if you work for 30, 40 years, it's not a matter of if, it's a matter of when and how many times and how often is that going to happen to you. And statistically speaking, it's going to happen 3, 4, 5 times to you during your career. You're going to have these downswings. How you weather those storms, because they get more and more extreme, how you weather those storms can either lead to more opportunity for you or more chaos for you. And so what I want to do is show you the more opportunity route. And you do that by saying 2 years of income in a safe account. Your friends may laugh at you because you're not earning huge high rates of return on this money. It's key that you earn a better rate than inflation on this money. That's essential because otherwise you're just going broke slowly. And it's also key that you make sure that you have the 2 years in there. You get there slowly, right? You first want to get a month, and then 3 months, and then 6 months, and then 9 months, and 12 months, and 18 months, and you kind of work your way there, but you do so slowly, right? And it's important to do that because the first year of income out of the 2 years, the first year of income is to protect yourself versus the economy, is to protect yourself, is to insulate your lifestyle, is to make sure you're protected, right? The second year of income in that safe account, that's for opportunity. That's for when the economy goes down right here. That's for that opportunity so you can find the right investment, and you can do so because it's part of your financial plan, part of your financial strategy. Now, one of the reasons I love this, and I'll tell you straight up, this is not for everybody, right? This strategy right here, from a risk perspective, is not for everybody because it forces you to be engaged in your finances. It forces you to take an active role in your financial strategy, because the thing that drives me nuts the most as a financial coach is when people come to me and they say, Chris, man, I don't know what happened. I've been struggling and I lost my shirt in 2008, and I'm like, well, where's your money now? Well, I don't know. I have a person who does that for me. Well, if you don't know where your money's invested, if you don't know what it's in, what rate of return you should be expecting, all that stuff, well, then you get what you have coming to you, because it doesn't make any sense. It's not fair with all the information available. It's not fair to scapegoat that away. You need to take responsibility for your own finances, and I think that's a big problem of what's going on in the world. So 2 years of income, that's a good place to start. The next thing that I think people need to have is they need to make sure their auto insurance, home insurance, etc., those, you want to have the right coverages, but you also want to make sure you're not paying too much. And I'm going to get into exactly details to make sure that you have the maximum coverage for the least amount of money possible with a good quality companies. And you could do that by simple strategies, and you can free up cash flow. So if you have this debt issue here, you can take a lot of money, you can save from your auto and home insurance. Your life insurance is the same thing. A lot of people I see just have simple term insurance, but they're paying 30, 40, 50% too much. So what we do is we find that money, we get them the same or more coverage for a fraction of the price, and we take the extra money that they were spending and we accelerate the debt payment. That's where we're going to save you a lot of money in this course, and I promise you we can do that on a 100% predictable basis, and we can make sure we structure your life in a way that gives you more security, guarantees, opportunity, and control in your life. Now, the last thing that I think that I tell people needs to be in this foundation of safety is disability insurance. I'm just going to write DI. Now, why disability insurance? Well, because simply put, disability insurance is cash flow insurance. It makes sure that no matter what happens to you in your life, that your standard of living is protected, it's insured, right? To make sure that no matter what happens to you, you're going to be able to keep your dignity, because if you become disabled, if you become paralyzed, if you become sick, if you're not able to work and keep your same occupation, we can set you up and we can show you ways that you're positioned so you can make sure that you have the proper disability insurance and the proper cash flow insurance, because that's all that is it's insulating your cash flow. So those are the big things. Now, here's why it's so important, right? Because I showed you the chaos and the mayhem that happens over with most Americans. But let's take that same scenario where the world's falling apart. But let's say you structure your life like this, and this is the foundation of your financial life. Well, what happens when the stock market tanks and the economy crashes, right? Let's say you can even lose your job. It doesn't even matter, because over here these people lose, right? Their opportunity goes down. Well, your opportunity is going to go up if you're structured like this. Why? Because it's a twofold thing. You have 2 years of income saved, right? Even if you don't have 2 years yet, if you can get to 6 months, 8 months, 9 months before the next time it happens, or even if you get to 3 months, you're still ahead of the game. The principle is the principle. You want to get moving on this as soon as possible, because it's not a matter of if there's going to be another correction in the economy, it's a matter of when and how violent it's going to be. And so you want to make sure you're prepared, protected. Even if you can't get all the savings in there, just understanding these principles, there are things you can do to protect yourself, right? So that's all I'm going to say. We want to make sure that we navigate that properly. But what happens is you have 2 years of income. That 1 year is to protect yourself in the economy. So that makes it so you don't have to make any stupid decisions with your money, right? Because you have that 1 year to protect and insulate yourself, and you tag that in with unemployment insurance if you have any of that. and you'll be very, very insulated and protected. In fact, you may not need a year, it may be overkill, but in that scenario, we use that extra money, whatever extra money you're feeling comfortable with that you have, you use that for opportunity. And when you use that money for that extra money for opportunity, that's when, in this situation, that's when you get your big rates of return. You can make 200, 300, 400% in a matter of years, where you can't do that in the stock market. There's virtually never been a time in the stock market you can do that on a predictable basis, yet you can do that here on a predictable basis by taking less risk. And so here's the other good part to it. All the money, if you do have money, if you've gotten to the point where you do have money in this high risk tank versus over here where you have it in the high risk tank and people are having to make bad decisions and they lose it all because they have to take it out just to survive and pay their bills, well, because you have this foundation, the money that you have left here, it's going to rebuild because you never had to take it out, right? You never want to take money out of a negatively performing asset. So that's going to protect you. Now, here's the thing. Everything I just showed you, if this doesn't make sense to you, I'm sorry. It makes sense to virtually everybody I've ever showed it to in my life. And what I can tell you is that while this is completely logical, you're probably thinking to yourself, how come I've never heard this before? This seems way too simple, right? It may be simple, but here's the thing, is that it's not in most financial professionals' interest to tell you this story. Because over here, a lot of the money, a lot of the commissions are made right here by selling people fee-based mutual funds and C-shares and all that stuff, telling people what to do. And I'm not going to get into all that and whether that's right for you or not. This is not meant to be a specific set of advice for you and your personal situation. What I can tell you is that it's imperative that you just understand the proper foundation and structure of a financial life to protect and insulate yourself. Because if you don't understand that, it only takes being hit in the market, in the economy, once or twice during your entire working career for you to not have the ability to retire and maintain your standard of living. So I hope that makes sense. We're going to get into this in a lot further detail. I have a whole week dedicated just to teaching the ins and outs of this. And by the time we hit week 3, where we get into debt, next week we're going to talk about your money personality and why that's so essential. And once we get through your money personality and after all the stuff you've just learned in this week, and we get through next week, and then we're going to get into the debt. We're going to fix and plug the leaks in your financial life, and we're going to go from there. So, and we're just going to progress, and we're going to teach you how to create more cash flow, and there's all sorts of really, really good stuff. So I'm so excited to be taking this journey with you. And I know that if you could just be patient with yourself and you could just take it step by step by step. I know it's a lot of information. It can be overwhelming. But once again, just stay the course with me. Do the worksheets as I give them to you starting in week 3. And you've already had a couple that you filled out already. Just do it slowly. Don't try to jump ahead because you'll hurt yourself if you do. Just take your time, walk through it. In week 4, you're going to get a free cash flow consultation with one of our professionals on our team that can help you out. And so take advantage of that. So until next week, I hope this is great. Watch it over and over and over. But until next week, live abundantly, live efficiently, live Life 180.